Hello, everyone, and welcome to Right at Home 2021 Virtual Forum, Duty to Serve, Examining Federal, State, and Local Policy. We're going to get started in another minute, give others time to join us on this webinar today. So take this time to get settled, get yourself some coffee, maybe a little snack so that you can participate with us for the next 90 minutes. Okay, welcome everyone again to Right at Home 2021 Virtual Forum, Duty to Serve, Examining Federal, State, and Local Policy. Before we start the webinar, I just want to go over a few housekeeping items. This webinar will be recorded and will be made available to registrants within 1 week of this call. That includes the PowerPoint slide deck. All webinar attendees are muted to ensure sound quality. But you can ask a question or share your thoughts anytime by typing into the text box of your GoToWebinar control panel. If you experience any technical difficulties during the call, email gotomeeting@prosperitynow.org. You can also be unmuted to ask a question to our panel verbally, and to do this, make sure that you set your audio option to phone call. Use the dial-in number and enter your audio PIN. The dial-in number, access code, and audio PIN are in the audio table of your control panel. If the control panel is closed right now, you can click on the arrow icon to expand your view. And to be unmuted by us at Prosperity Now, you and join the conversation, click the raise hand icon and we will unmute you. This session is part of our I'm Home Network virtual forum sponsored by NeighborWorks and Wells Fargo, so we thank them for their support. We had a call earlier today on ensuring manufactured housing stability post-pandemic. If you were not able to join us for that one, you can find the recording for that webinar as well as PowerPoint deck on our website. We'll post that in the next few days. And tomorrow we have 2 more sessions, building a more resilient manufactured housing industry and reimagining the future of manufactured housing. As you know, Prosperity Now has hosted I'm Home for a couple decades now. We've taken action on a number of federal, state, and local policies and supported various partners as they provide expanded access to financial products, increased manufactured housing supply, and increased ownership opportunities for low and moderate income households not able to enter the mainstream housing market due to unnecessary barriers. And we thank you all for your partnership and your membership during that time. With that, I'm going to pass it off to our moderator, Stacey Epperson from Next Step.
Thank you, and thank you and welcome to everyone for coming today to participate in this I'm Home webinar on Duty to Serve. So I'm Stacey Epperson. I'm the founder and president of Next Step Network. And let me go through and introduce our speakers today. So with us today, we have Jim Gray. Jim is a non-resident fellow at the Lincoln Institute of Land Policy, and that is based in Cambridge. And Jim helped really create and lead the Duty to Serve program while he served at the Federal Housing Finance Agency. Also with us today, we have Dennis Smith. Dennis is from Freddie Mac, and he's the Affordable Lending Manager, Single Family Client Community Engagement Manager. Many of us who have worked with Duty to Serve programs at Freddie Mac know Dennis well. Also from Freddie Mac, we have Corey Aber. And Corey is the Senior Director of Multifamily Mission and Strategy. And so he's going to be talking to us a little bit more about land lease communities and strategies that Freddie Mac has in that area. Also with us today is, I think, one of our very important lending partners, David Blazek from Guild Mortgage. And there, David serves as the Director of Product Development. And I think David used to work at Fannie Mae. So we've got a well-rounded panel here to talk about duty to serve. Now, we don't have a PowerPoint deck to take you through today. We're going to have a dialogue and conversation about duty to serve. Now, before we do that, though, I'm going to speak a little bit about Fannie Mae and Freddie Mac. Sometimes we call them the GSEs, the government-sponsored enterprises. And I'm going to speak to duty to serve, but I'm going to do it in a way that I think is very elementary, plain speak. Many of you on this call today are advocates, housing advocates, right? And you're not in the finance world and the lending world, and so sometimes I think our eyes glaze over a little bit when it comes time to do the I'm Home Duty to Serve panel. And so what we want to do is really make sure that you're comfortable with duty to serve, that you understand it, and learn how you can engage with it, right? It's an opportunity for us to shape public policy on Fannie Mae and Freddie Mac's commitment to affordable housing and manufactured housing. So today my role is moderator, translator, and facilitator of your questions. So I want you to feel free to ask questions today. So what do I mean by translator? So this is when I think we get caught up in our wonky language and we don't break this down into plain speak. And it's so important to our advocates' work. So I'm assuming, you know, that some of you may even be homeowners, right, that participate with us as advocates. You know, manufactured housing is our most important affordable housing option for so many in this country. So it's my goal that we have you engaged to participate in the policymaking arena, to have a voice into both how Fannie and Freddie serve this market, and to make it work better for the individuals and families that we all care about. You know, why are we working with these two behemoth companies, as I call them? Why do they even matter? They do matter. And how can they help you meet your mission? So today we're going to take what I'll say is a ride on the Fannie and Freddie super freeway. Okay, so just bear with my little story here. Their role in the housing market is to provide liquidity. I know it's one of those wonky words, right? But basically they buy loans from lenders, which helps those lenders manage their risk. That lender gets paid for that loan. They get that loan off of their books, and now they can take that money and make another loan, right? And so this freeway has guardrails, if you will, which is really Fannie and Freddie's mission. Fannie and Freddie then sell these loans to investors who want safe and sound loans with good collateral and credit of borrowers to protect their investment. You know, this freeway runs from Main Street banks all the way to Wall Street, if you can think about it in that way. And when this system works correctly, then we get these wonderful 30-year fixed rate mortgages, which is how housing gets done in the US. And it makes us a homeownership society. It's the infrastructure for the American dream. Well, but let's just pause here a minute. How many manufactured home buyers do you know out there taking advantage of a fixed rate 30% mortgage, which at today's rates could be less than 3%. I think it's about 3% today, okay? So we've got a lot of work to do to get our manufactured home buyers on this freeway, all right? Now let's talk about who establishes the rules of the road. You know, I would say that's a lot about what we call standardization that both Fannie and Freddie do in this finance system. They standardized the loan process, the paperwork, the technology, the application process, how loans are delivered, what loans get approved, the underwriting, kind of dictate what happens. And it's sometimes we want to call this the conventional loan market. But they also kind of address the traffic bottlenecks. It makes the whole market run efficiently, so loans speed up and down what I'll call the Fannie Freddie freeway from Main Street to Wall Street. So thank you for listening to my little bit of story, but I just wanted the homeowners to kind of have that background as we go into this. So let's talk about mission. Both organizations have a mission and they have to serve affordable housing goals because basically they were created through Congress, right? And so how did we get to duty to serve? Well, Congress said that first of all, they passed a law. So this is statutory, it's a law. They told the GSEs to innovate to address the problem of manufactured housing. We care about one of these woefully underserved markets. There are two more, but today we're only focused on ours, manufactured housing. Now, I know in 2008, there was a big crash out on the freeway, right? We don't have to talk about that today. But because of that, we really kind of have to think about how the Federal Housing Finance Agency plays a very important role in this market. And I would call them the big traffic cop, okay? They're the regulator that makes Fannie and Freddie meet their affordable housing goals and duty to serve. They dictate how fast we go, kind of who gets pulled over, when some people aren't following the rules. But the good news is that this cop takes input from the public and advocates like us in order to set the rules, okay? So if I'm an advocate, I need to get educated, understand the timeline for input, and how best to affect change. So I'm going to ask my friends at Prosperity Now to pull up one of the, I think, a very important tool that the Federal Housing Finance Agency has made available. It's on their website, and it should be in your chat box today or this link sent to you so advocates can use this tool. You can click on the manufactured housing gold house, right? And then we can see how Fannie and Freddie are really performing against their goals, okay? So when I look at this, some of the things that stand out to me, and I hope it stands out to you, like, first of all, I see my state, Kentucky, all right? Okay, I can see down to the county level what's going on. And I can see the kind of the penetration that they're having in these markets. But when I look at this, one thing that really stands out to me is that both have a very low percentage of manufactured home loans in their overall portfolio, okay? So there's a lot of room for improvement for both GSEs here. And they know I always advocate we should be doing double, triple this than what we are today. And then geographically, when we look at this, where we have those lightest colors, what stood out to me is that where we have some of the lowest loan production, we also have some of the highest manufactured housing shipments in the country. Look at Texas, look at the South, right? So that's something else that this is how you can use this information. And so I hope that you do that. So thanks for listening to my freeway story. Advocates, I want you to get on board with us, and I'm going to start asking some of the panelists questions about how we engage as advocates.
Stacey, can I, would it be okay for me to make an observation about the?
I'd love for you to, Jim.
So to me, the line that stands out like a sore thumb is the turquoise line. And that's the line that shows how manufactured housing deliveries to the enterprises have decreased in the last, at least they did in 2019. And I worry that they may have decreased further in 2020 when we have that data on this chart. And that's a very worrying trend to me. And I don't think, I think when you compare it to the other originations, that you can't just use the pandemic as an excuse. And in fact, in 2019, there wasn't even a pandemic. So there needs to be some other reason for that.
Yeah, I saw that too, Jim. And so look at 2018, how we were doing. That red line is like, you know, we're trucking along, right? And that feels pretty good to see that improvement. So let me ask David and Dennis to chime in here. Observations or respond to, what do you think happened between 2018 and 2019? So Dennis, starting with you.
Thank you, Stacy. So maybe I'll start with Jim's observation. I think once you see the 2020 numbers and even what the 2021 numbers will be, that you will be encouraged by the trend lines. We have seen an increase in production. And I think part of what we're seeing in that 2017 through 2019 dip could be us really getting our feet underneath us, right? We implemented the duty to serve rule, and we wanted to take a new lens to manufactured housing, so much that now it is part of our DNA at Freddie Mac. And when we look at new offerings and new loan types, we're at the table talking about manufactured housing and how could manufactured housing homeowners or home buyers benefit from our offerings and our product set.
Okay, so thank you, Dennis. So Dennis thinks we're going to see a better trend line. So David, any thoughts or anything different you've seen with this?
Well, first thing I'll say, Stacey, I got to apologize for my neighbor mowing the lawn right outside my window. So I apologize if that's distracting. So I absolutely agree with what the gentleman were just saying. Ironically, in our company with Guild, our company is not following the same trend line. Every year, our company's manufactured home loan deliveries to the GSEs and government has actually been increasing. So, but if I had to think about what causes maybe some of this change, I think one might be with the Fannie Freddie's affordable programs. So when their area median income dropped from 100% down to 80, personally in our company, that was about 40% of our affordable business to the GSEs, of which a large chunk of that were manufactured homes. And we can go to get into lending programs, but I think that was certainly a chunk of it. But I guess maybe proud is maybe the right word to say that our company is actually not trending in the same line. So I can't really say what's happening in the market. And then one thing that Jim was saying, you know, regarding the states, individual states, our company actually does follow these. I'm looking at like the top 4 states of Guild and our manufactured home deliveries. It is where the shipments are going to. So it is the, you know, Texas and Texas, Oregon, Nevada, Arizona. Those are our top 4 states for deliveries. I'm sorry, for production.
Okay, all right, good, thank you. So I appreciate engaging on this tool. Let's move to a couple of questions here. So we're going to be talking about the overall advocacy process. So I think this is a really special time to be having this conversation. The question is, what do we think we expect under a new administration, right? So we've had change. Even though we still have the same CEO, of course, in place at the Federal Housing Finance Agency, do you think they'll be aggressive, or do you believe they're constraints? And then I want each of you to think about what's your outlook for the future. So Jim, I'm going to start with you on this one. What do you expect under a new administration?
Well, we at the Lincoln Institute expect an awful lot. The way we think about it, you know, when we read in the news about constraints on the president's agenda, so often they're talking about things that have to get through Congress. But now with this recent Supreme Court decision saying that the executive director of, or the director of the Federal Housing Finance Agency reports directly to the president, and this person has an immense amount of authority. They control about 20% of the whole economy of the United States. And the president can basically have that person do whatever the president wants. So we're expecting that the Biden administration, whoever ends up being the permanent director, is going to exercise an awful lot of its discretion in regulating Fannie Mae and Freddie Mac to insist that they be much more aggressive than they have been. And while I've got the floor, I'll just briefly mention that just this morning, a group of about 20 of the most, I'll say the leading affordable advocacy organizations in the country joined together with us to form the Underserved Mortgage Markets Coalition that we'll be formally announcing in a couple of weeks. But this coalition intends to do a lot better job of collecting data about enterprise performance and plans and comparing that to what's happening in the rest of the mortgage market, and really working closely with Fannie and Freddie to see if we can't get them to up their game a little bit.
Okay, excellent. You know, I'm really excited about where the administration's going on increasing housing supply and the Build Back Better agenda, and seeing manufactured housing called out as a strategy to increase supply. So David, knowing that, and knowing that both Fannie and Freddie have created products on the single family mortgage side for manufactured housing, what's your outlook for the future?
Well, I will tell you that I'm very excited about what Director Thompson, Acting Director Thompson, has been saying already. As Jim was saying, I think we've already seen a lot of, change and discussion happening since she's been in that seat over the last few months, and I really believe that that's going to continue to escalate. We have been having a tremendous amount of strategic calls with both Fannie and Freddie, specifically around duty to serve goals, whether it's MH, rural, low to moderate income, or an overlap. Guild has had probably arguably one of the best first-time homebuyer programs over the last few years, partnering with both Fannie and Freddie, and also with the Home Depot. And we are creating another one right now. So, you know, in the last couple of years, it's been difficult to maybe get some variances and things with the GSEs. I think going forward, I think both Fannie and Freddie are going to be much more open to discussing variances that will certainly help those first-time home buyer situations. So I'm just very excited about that. Like I said, I think there's been a lot of traction over the last few months, and specifically with manufactured homes, I tend to lead up there with those strategies within Guild. Been having a lot of really great planning and strategic action going on with both Fannie and Freddie, and also some of the largest manufacturers in the country as well. And we've got a few developments kind of happening around the country, anywhere from 4 units up to hundreds of units that that's already in the works. And the last thing I was saying, I'm sorry, be quiet. I do think for this to really gain a lot of traction and awareness, it's going to take a lot of education. And I'm sorry, Stacey, already, every time you ask me a question, I'm going to probably use the word education. Not just for the consumers, but I don't care if they're zoning officials, local government officials, real estate agents, developers. The more that we can educate on what a manufactured home is, anything from a single wide to a cross mod, everything in between, the more education that we can do, the better. And the more we're going to break down that perception that's been in place for many years. And I'm sure we'll probably talk about that as well.
Yeah, thank you, David. So Dennis, I'm going to ask you the next question. We're going to shift to thinking about advising advocates. What should they know? What's the 1 or 2 top things an advocate should know about the process right now of advising and giving input to your duty to serve strategy? So I'm sure Freddie Mac's working on their plan. Talk us through that a little bit.
Sure. So in partnership with our regulator, FHFA, every 3 years we put out a new duty to serve plan. And one of the best ways to do that is through public listening sessions, and also when they ask for comments on the initial draft plans. So we had gone through an exercise earlier in the year. In May, we submitted our initial draft plans, and we went through a listening session in early July, where probably many of the folks on the call listening today were present or provided written commentary through the FHFA website. So we look at that information and we take that to heart and make some adjustments to our plans. And we do a lot of outreach to many of the ecosystem of manufactured housing. And if that's something, unfortunately, we can't reach everyone, but we would love to hear those thoughts from the advocates of what their opinions are and what would benefit the market.
You know, I've kind of learned that going through the process myself, that it kind of can be this reactive, like, so you have a plan and then we go to a listening session and or we do comment letters once the plans are out, right? And it's reactive. So I'm wondering if there's any proactive approaches maybe for advocates to engage. Jim, do you have any thoughts on that?
I do. One of the things that I encourage everybody to do, and that I think in the long run we would like to see added to the planning process, is for advocates to be more specific and more upfront about what they want to see in the duty to serve plans, rather than just waiting for Fannie and Freddie to write up plans that we don't think are as ambitious as they should be, and then put us in the position of having to respond to that. We'd like to see this turned around to where the process would start with people suggesting what should be in the plans, and then ask Fannie and Freddie to craft their plans based on that. And I have to say that the plans that came out this past spring, you know, it was a very different environment with a different director who was very discouraging of duty to serve. And there are a lot of FHFA policies that make it hard for the enterprises to really put together ambitious plans. So we're advocating that FHFA make some of those changes, but we really just don't feel like where we are in this process is at a place that we can be satisfied with the plans unless major changes are made by FHFA and the enterprises to the plans that are that we saw in the spring.
Okay. And Jim, can you remind the audience of some key dates or time frames, like kind of for this process, when they should be doing this, working on this?
Well, so the unfortunate thing, the unfortunate answer to your question is that most of the formal dates have passed. And so it's gonna really be something that FHFA is gonna decide. I think our inclination is to ask the enterprises to sharpen their pencils and come out with something public again before Thanksgiving, in hopes that they could come out with something that we could then advocate to FHFA could be approved before the end of the year. But you know, if we're stuck with anything like what they came out with early in the year, we're going to have to be in the place of advocating that the planning process just can't be completed this year. It'll need to be restarted next year. And we would sure hate to see that, and we expect they would too.
Okay, okay. So I hope we've painted a picture here that everybody's needed, right, in the planning process, right? And we need to get more active with Fannie, Freddie, and FHFA as an I'm Home, Next Step, Rock USA, National Manufactured Homeowners Association networks, right? So I hope we've got people holding up their hands to do this. Let's talk about, are we missing anybody in this process? You know, it's such a niche industry for manufactured housing. How can we engage, say, more lenders and other market actors? David, any thoughts on that?
Yeah, well, I don't know if this answers the question. I think that the GSEs and the regulator can have the best possible duty to serve plan in existence. Anything that we would want, it's there, it's great, everyone loves it, but it's kind of worthless unless it's executed, right? Mm-hmm. And Freddie and Fannie, that they have, that they're not going directly to the consumer, right? That's our job as a lender, as a realtors, developers, et cetera. That's their job. That's our job. So I do think that's the miss and that's the gap. So to your question, you know, how can we get more lenders involved? I don't think it's, I mean, Guild can't do it alone. I mean, Fannie, Freddie can't do it alone. It is going to take all of us, and it's going to take a very, very long time to make to make this happen and move the needle. If we want to take, manufactured homes, from the 10% what it is up to even 12%, I mean, what's that going to take? It's going to take more lenders being involved and engaged, but even going beyond that, it's going to take them to have plans that are executed as well. For example, with real estate groups, with developers. I've said this 100 times. I really don't think that MH homes we're not going to see more home sales until those two groups are in the picture, meaning developers and real estate. So, I mean, if we're going to wait for the families to drive into the MH retailer and hope and pray that, that the home sales increase, they won't. So I do think that the realtors got to be in that space, whether that's, with the national realtor groups to educate them, to educate them on what these homes are, not just cross mods, but single wides, with the GSE is now taking on single wides. I think that's going to be a huge pickup. And then with the developers, whether they're putting in 14 homes or 1,400 homes, for them to truly understand the pros and cons of actually doing all site built versus doing, a scattered with factory built or even all factory built. And in talking with some of these very, very large developers and the margin increases that they're going to have by doing off-site construction, avoiding the weather, avoiding waste, just getting homes to market much, much faster. It's not going to be a solution for the housing inventory issues and the home financing issues. It's certainly not an end solution, but it's certainly a step in that right direction.
Do you think we're making any advances in the appraisal challenges, or what are you seeing in your business?
Slowly. I think personally slowly.
Okay.
And as a lender, we're not talking to appraisers directly. We're leaning on the AMCs that we use, and in talking with a few of the national directors and even some of the AMCs, and I'm educating them as to what cross mod homes are. I'm educating them on Choice Home and MH Advantage, and not just with the conventional loan, but even with an FHA loan. And then what they need to do, how they need to instruct their appraisers on what to take with them when they go to the site, whether it's a checklist or just making sure that they add verbiage or take a picture of the sticker. Very simple things like that. You would think are very simple, but unfortunately they're not. So again, I go back to educating, right?
Yeah,
Just
education takes investment, right? So Fannie and Freddie, I hope, we're thinking about, we're going to have to get back on that outreach investment. FHFA needs to give you the credit you need, because so much more education, as David's telling us, needs to be done, right?
Right.
Okay.
Right.
And to David's point, one of the things that we constantly do are educate lenders, our lender base. And we also have groups that deal specifically with the realtor associations and some of the different industry associations, where we get in front of them and we talk about manufactured housing. I think one of the best ways to really change someone's perception is to show them how much manufactured housing has changed, and get rid of some of those preconceived notions of what manufactured housing might have been, but they need to realize what manufactured housing is today.
And Dennis, I don't know if you wanted to elaborate on that, like as to what Guild is doing with your affordable group between now and the end of the year. But
Sure.
Go ahead. And it shouldn't just be Guild. They should be doing it with other lenders as well, which I know you are.
Absolutely. So in addition to training our lenders, we have a specific group that works with a subcategory of lenders. So they're very similar to like an account executive, but they're specific to affordable lending. So one of the items that they are going out and educating not only the lenders on, but partnering with the lenders to put on, well, in today's environment, webinars for their referral bases and their customers, those that they support in the ecosystem, everything from real estate professionals to appraisers, to talk about manufactured housing and do different sessions. We could talk all day. As a matter of fact, we worked with Appraisal Institute to develop a new curriculum for manufactured housing, including the cross mod of the Freddie Mac requirements for Choice Home and the Fannie Mae requirements for MH Advantage. But getting the appraisers to actually take the course can be a challenge, especially in today's environment when volumes are up so high, and appraisers might go with what they know, right? They might say, okay, we need 2 manufactured home comparable sales. But I think education and outreach, we are doing those things, and we continue to do that and look for new innovative ways to tell the story about manufactured housing.
Okay. So land use and zoning barriers are one of the reasons we can't get manufactured homes in many, many communities, right? So what can industry and housing advocates do with zoning proposals to kind of innovate, or something maybe you've seen that might work to advance zoning changes at the local level for manufactured housing? So Dennis, have you seen any pilots or anything that have moved the zoning needle?
So in contact with some of the different state associations, they have really taken an approach to zoning by showing what manufactured housing can do and what it is capable of doing for their communities, and how by changing their zoning laws and allowing manufactured homes, how they no longer have blighted empty lots, how they actually have a home, and they're seeing that the neighbors around them, because there's a new construction home in their neighborhood now, are taking a little more pride in home ownership and cleaning up their sites and their local areas. But I think one of the challenges is when those in the industry go in and put the best foot forward, they actually have to deliver when they put homes on site. If you're showing cross-mod homes that have a residential look and style, but you end up bringing in a traditional manufacturer that has a 30-inch set off the ground, then that might make those zoning officials think twice about looking at manufactured housing. We are doing some research to identify where the zoning is friendly for manufactured housing, and we're doing some cross-referencing with where loan originations are today for manufactured housing, and also where those customers that are mortgage ready are located. So by a simple process of triangulation, we could identify markets that are primed to grow for manufactured housing that may not have those zoning barriers.
No, I'd be interested in seeing that when that's ready, for sure. Okay.
And I had a question, actually, Stacey, for Dennis on that. So I'm a data dork and I love stuff like that. So, the markets that have a certain percentage of mortgage ready, homeowners, aspiring homeowners, combined with maybe markets that have MH kind of zoned out. Do you think that those zoning restrictions are that way because of a negative perception, or just because of they zone out MH because they just don't want the single wide box that's coming in? Meaning that they just may not be educated on the new choice home, et cetera, and that just by being exposed to that could open up zoning for those markets.
I think a lot of that is the past negative perception of manufactured housing. I think if we look at how media portrays in movies, et cetera, that is not today's manufactured housing. That if we really put forward what manufactured housing is today, that it is a high quality home, that can really change those perceptions.
I feel like we've been talking a lot about probably the multi-section home, kind of cross mod, single family mortgage side. So I'm going to start shifting us over to the more affordable product, usually single section home. So Dennis, would you just touch on the change that FHFA has given Freddie Mac approval around single section home financing?
Absolutely. Thank you, Stacey. So Freddie Mac sees that a single section home is a way for a customer to realize the dream of home ownership and begin to build wealth. Our guidelines had only allowed a single section manufactured home when it was located in a planned unit development or in a condominium development. So we worked with our regulator, FHFA, and our credit policy folks to change that so we can have our lenders originate single section manufactured homes as real property and deliver those, excuse me, to Freddie Mac. We don't have a lot of data on that. So currently it is what we call a published negotiated term. So it's published in our guide, but we want to make certain that the lenders that are originating that have experience in manufactured housing, and for us to build some data on the performance in the homes themselves, so we could hopefully remove that and maybe even look at expanding the program in the future.
Okay, so my next question is that we're going to talk about data in a minute. The Consumer Financial Protection Bureau reported that just less than half of all manufactured home loans. Yes, Jim.
I'm sorry. Before we get to that, can I just ask Dennis a little bit more about the single wide? So, Dennis, I think everybody on the call probably would join me in saying this is a really good thing that Freddie has done. I think Fannie had already done it. And so one question that I have, and I really don't know the answer to this, but we're always hoping that the enterprises will help lead the market as opposed to following it. And so I'm wondering if there is anything in the new Freddie product that tills any new ground that Fannie Mae, or is it just the exact same single wide product that Fannie Mae has? That's question one. And then question two is, what can you tell us about your plans for like how many units you'll buy on a pilot basis this year and next year?
Good question.
Yeah, so that's a great question, Jim. I think our product will be very similar to what Fannie Mae is offering, but with some minor differences. And I think it's not truly a pilot. It is just open to any seller who would like that term of business. And I think part of it is trying to differentiate and hum the data to identify what's a single section versus a multi-section. That it's very difficult to come up with a good estimate of what we would see from single wide deliveries. So I think what we're looking to do is really start to build some of that data through this offering. I know that there is a lot of interest from our lender base, and it's just not the guilds of the world. David and his team do a great job, and they're a larger lender, but we're also seeing some of the smaller lenders, more of what I would call a community lender, who are interested in serving their customers who purchase single wide homes.
Okay.
Okay. Whenever you get that those projections, I think a lot of us would be all ears to know, even if you could just tell us in a ballpark what you're shooting for. But I understand you don't have it yet.
Okay. Okay, thanks for that. And so let's talk about how we can finance some of these homes. So I'm going to kind of move us to chattel or home only financing questions. Been focused on the mortgage side. So earlier this year, the Consumer Financial Protection Bureau reported that just less than half of all manufactured home loans are chattel, which is less than many of us thought, right? And chattel will remain an important source of home financing. What do the GSEs need to do to create a safe and affordable chattel product? So let's start with Dennis on that one.
That's a great question, Stacy, and I know that we had gained a lot of momentum in developing a chattel program, but unfortunately, COVID-19 pandemic kind of came to light, and we had to look at our priorities and what we had in development versus what we could do in response and reaction. We do not have unlimited resources at Freddie Mac, so a lot of the resources that we did have available working on new projects and initiatives we kind of had to pivot over to our pandemic response. And when you think about that, we have to make IT system changes and everything like that. So it really pivoted that way. We're excited about the leadership at FHFA and some of the initiatives that the Biden administration have come out and publicly said. So I think it's an opportune time for us to look at chattel or home-only loans as an option for affordable housing. So I think it's good for us to take a look at that and re-engage with our regulator around those conversations.
Okay. And David, does Guild do chattel lending?
No, we do not.
Okay. All right.
Yep.
And Jim, is there anything you want to add to this question?
No, I think what Dennis said pretty well covered it. It would really be just very important, I think, for this whole conversation. In fact, it's hard to think of anything in this whole conversation that we're having for 90 minutes that could make more of a difference in making manufactured housing the solution to the affordable housing crisis than if Freddie Mac and Fannie Mae could figure out a way to actually get into the chattel business.
Okay, all right. You know, the same research and Fannie and Freddie's report and show few manufactured homeowners refinance their homes, right? So they're spending potentially more than necessary in this low rate environment. You know, I think about the family who may be in a single section home. Maybe they originally financed chattel and they're out in rural America, right? And you know, they might be paying 8-9%, and you know, what would it take to get that really lowered and save them a lot of money? So how can lenders, the enterprises, and FHFA change this? So Jim, I want to start with you on that. Any thoughts on refinance?
You know, I have to defer to either David or Dennis. They have much more expertise on that than I do. But after they say a piece, maybe I'll be able to add something.
Yeah, well, I posed a family here. So, you know, this family's in a single section home, right? So there's some challenges here. We'll start with Dennis. If we wanted to get that rate lowered, is there an approach to do these kinds of refinances?
Yes, there is. Through the new announcement of our single wide policy, we permit not only the purchase but also a refinance transaction. So I think some of it is education of the consumer, right? And one of the challenges also could be some of the lower loan balance amounts. If you think about those truly affordable homes, where is the benefit of refinancing from a cost perspective, and when does it make sense to do that on some of the lower loan balances? Does it make sense to pay the additional closing costs and fees associated with the refinance transaction, and how long will it take to recover those costs? But I think education is one of the largest items, educating the consumer and educating lenders that, hey, this is a great market opportunity for you to go out and to help customers.
Yeah, so I have to put my 2-minute homebuyer education support for manufactured housing consumers is huge. We think both the GSE should be investing more in this. Then you have just pointed out one of the reasons why we need to do this. So I'm gonna keep us moving. I'm amazed how fast this is going. We actually have another participant. You just can't see him. Corey here, we haven't forgotten you. I hope you're still with us because your questions are coming up for you. Our land lease communities are so important to serve in so many affordable housing needs across the country. And on the multifamily side of Freddie Mac, I know that you can touch these communities. So the question is, private equity and other actors have had a significant impact on manufactured home communities across the country. What should the enterprises and FHFA's responses be? How should you be approaching these communities?
All right. Thanks, Stacy. And yes, I am still here. And sorry to everybody, you can't see my face. Hopefully you can hear me all right.
Yes.
I think I think maybe before I answer that question specifically, since we've spent a decent amount of time on single family and home ownership questions, maybe we can just go back to your metaphor from the beginning and the freeway and just how some of these things work. So on the multifamily side, we're also a secondary market participant. We buy loans from lenders, and those lenders make loans to the communities themselves where homes are often placed. And so those loans are secured by the rents at the pad rents at the community. And so, yeah, there has been a lot of attention in the past few years around, private equity and other actors, as you said, coming into the space, increasing their presence in the space, et cetera. And I think, one other thing going back to the initial point is, our role in the market relative to others. So we are one of several capital providers in the MHC space. Right? So there's Fannie Mae as well. Life insurance companies do a lot of manufactured housing community loans, banks, commercial mortgage-backed security conduits as well, and then even some housing finance agencies. So we're not a huge part of the MHC market. We're a sizable part, but we're not the only ones there. And so, our influence is sort of limited to our presence in the market and the standards we can advance through that. Right. So the owners today, they have a choice of where to go to for financing, and we're competing on deals with all of those parties I mentioned above. And as part of that, right, so our business, we work with a range of borrowers. We work with the smaller mom and pops. We work with mid-size operators and also some larger operators, generally with a track record of doing MHC business for a long time. But most of our business tends to be with the mid-sized firms. And what we've really been focused on, right, is how do we use our place in the market to advance better protections and better experience for tenants, so that when we're providing financing for MHCs, tenants are getting something more than they would get through other capital providers and more than the minimum required by state law anywhere in the country. And I'm talking about specifically our MHCs with tenant protections offering. And that I know we announced recently that we are requiring these tenant protections that are described in Duty to Serve, that came about through Duty to Serve, through Jim's work. And I think many people on this call, we're making that a core part of our MHC business. In fact, all of our MHC business going forward. So that, I think, can really help get better arrangements for tenants, more protections for tenants, and hopefully that drives more adoption across the industry.
Yeah, thank you for that overview, Corey. I want to see, Jim, do you have a question for Corey?
Yeah, so Corey, you make a great presentation, and I think it's good that you brought us back to the highway metaphor to sort of keep us all grounded. And it's also good to see that Freddie Mac is engaged on the tenant pad lease protections. But if we could just put aside the pad lease protections first before we get to that, and we're just talking about the financing. So some people like me who spend a lot of time advocating for the enterprises and the mission role of the enterprises in the market as being distinct from, say, a lot of those private capital providers who you were referring to, who make up a bigger share of the MHC market maybe than Freddie Mac. It occurs to me, and I'm curious how you see this, that because the federal government provides Freddie Mac with an advantage in the interest rate, what responsibility does Freddie Mac have to make extra efforts than those other capital providers that you cite to provide lower cost financing and to do things like finance resident-owned communities that was so eloquently talked about in the recent podcast that Chris Arnold put out on NPR, if you were able to hear that?
Yeah, no, great point. Happy to talk about resident-owned communities as well, and we can we can cover that a bit now, if you like. So for
But
that point,
first, can you just start with talking about how you see, to the market as a whole, what special responsibility does Freddie Mac have that makes it different than the responsibility of all those other for-profit capital providers who don't have a government guarantee?
Jim, I think, I did touch on what we're trying to do, to advance, more to the advantage of tenants with the tenant protections. That is a key part, right? So our business, really the way we're focusing our MHC business is on that and on resident owned and nonprofit community business. So that will be our exclusive role in the market, in the MHC space. That's all we're financing going forward.
Let me make sure I understood that. So we'll stay on this. So resident owned and mission driven ownership models. Are you saying that that's your future of what you're going to be doing?
That and communities that implement these tenant protections through duty to serve that are above and beyond state law.
And that's not just duty to serve, that's all your book of business, is that right?
All of the MHCs that we will do going forward. That was our announcement, right? So all future MHC transactions that we do must have the duty to serve tenant protections, or be a resident owned community, or be nonprofit or government owned. So in one way or another, a duty to serve qualifying MHC.
So there's a lot of good to that, Corey, and I don't want to take away from it. However, there's still the problem that it's so much easier to do the kind of Haven Park sort of deal where the predatory lender is willing to help a developer come in and acquire a park, and then jack up the rents, and even using jacking up the rents as part of their underwriting for the deal, than it is for the tenants to buy the community themselves. So I think part of what I'm trying to get to, and I don't know if this is what Stacy was asking too, is what are you all going to do to be sure that you're not making this problem worse of these Haven Park type deals where we have fewer opportunities and the pad lease rents are going up rather than down?
Yeah. So again, Jim, I mean, the business that we're focused on is not that business. It's doing business with borrowers who will implement the tenant protections going forward, which I think are an important step, right? Getting to resident-owned community is important, right? It's a model that gives a lot of control to the residents. I think it's not easy to implement and turn over very quickly. That's why you have expert groups who do it and assist. And so what we're really trying to do in the meantime and help make this easier over time is focus on tenant protections is a really important scalable step along the way. Some of the protections in there do help move towards resident ownership, right? The right to receive at least 60 days notice of planned sale is that's more notice than is involved in many states, and that can help residents organize and get together to make a bid on the community.
Okay. I just want to remind our participants that you can be asking questions in the chat box, which we'll be moving to and just a little bit later in the session. And so please, as you have questions, I know this is some good news to absorb, like we're hearing some good stuff today. And we're hearing how to be better advocates. So let me just check with Dennis or David to see if there's anything you want to add to this land lease community discussion with Corey.
It's actually outside of Guild's wheelhouse, so we're not lending in that space. So I'll turn it to Dennis.
And Corey is our multifamily expert, and they're the ones who finance the leasehold communities. So Corey would be the authority.
Okay, so we
Yeah,
need
and actually,
a
Stacy,
title
before we,
product to actually, I mean, if Freddie Mac is lending for the community, we still need a product for either a mortgage or a chattel, or however we can make that work for the families living in these communities. That's still a need too, right?
Correct.
Okay, all right, very good.
Stacy, if you don't mind, before we move on to the next question, I do just want to add a bit about the scale that we've already been seeing with the tenant protection adoption. And we were able to get to this point because we have reached good scale and good adoption in the market. So we expect that by the end of the year, we'll have financed at least, through our lender network, at least 75 communities that implement the tenant protections, at least 7,500 pad sites, so that's 7,500 households who now have these protections. I do think that we will see growing scale there over time.
Talk to me a little bit more about what you've been able to do for resident-owned communities and mission-owned communities.
Yep, no, happy to. So resident-owned communities, as I said, those they're very hard to convert, and we don't see a whole lot of those transactions, to be honest. We've financed 3 so far. We have another one that we've been working on for 2 years to do, and hopefully that one will close soon. But we've had a product out in the market to finance ROCs for a few years. I think that it will work especially well for refinances, but works. We have it set up so that it can work for conversions as well. I think a key point there is we'd like to see more of these, and that means for any resident-owned communities in the audience, or any nonprofit-owned communities in the audience, please contact our lender network. We're ready to look at these deals. We have done them. We would love to do more, so certainly bring those to us. Feel free to reach out to me directly, and I can help connect you to the lender network if you don't know our lenders today. But we do think that's an important part of the future.
Okay. Well, I
So
agree.
maybe just one last thing that I'll say about the pad lease protections. And again, Corey, hats off to you that you all are taking this step. We appreciate it. But if I were to put myself in the position of somebody who lived in a community and I'm fully protected by your tenant protections, and I get a 60-day notice that in 60 days my park is going to be sold to, Haven Park or somebody worse than that, and I have to do something in 60 days, that's not a lot of time for somebody to arrange to get their unit moved or to sell their unit or really to do anything. And of course, the pad lease protections were a start, and they do establish that you can use securitization to make social policy, which, as I recall during the rulemaking, everybody said we could never do that, but actually we've managed to do that. But if Freddie Mac really wanted to make a big difference, and you extended that particular tenant protection, just that one, from 60 days to a year or 2 years, boy, that would make such a difference in this market, and it would do so much to discourage these predatory lenders from coming in and trying to acquire these parks, particularly since Freddie is so influential in the market, we could get other people to follow your lead. So let me just put that out there as a possibility and maybe ask you to think about whether that's something you'd consider.
Oh, thanks for that, Jim.
Well, Corey, I'm going to ask you a question that I just thought of. So, and maybe a crazy
Sure.
one, but what would it take to get a new community built? Say you've got a nonprofit developer that wants to be a mission-owned owner, right? And keep it affordable in perpetuity. I know zoning's hard, but there are places in the South I know where you could go in and do a new community. Is there any way Freddie Mac could help with that?
Yes. So for new communities, I've heard this talked about in a few different ways. So first off, we haven't seen a lot of new communities
Right.
be created. So with that in mind, I think, you know, I've heard different approaches being pursued in the market. I've heard consideration of starting communities through tax credit programs or using you know, low-income housing tax credits to support the construction of a community, but using manufactured housing as the housing stock in the community as opposed to apartments.
Right.
And I've started to hear you know, build to rent models, thinking about this approach as well, using manufactured housing. I think, you know, we would be there to support the permanent debt on any MHC, so long as it implements the tenant protections or is a ROC or
Mhm.
is
Yeah,
not
you could also buy the tax credits, right?
Yes, and we can invest in tax credits,
Mhm.
and we do that.
Okay.
I think the challenge where we are today, we are not a construction lender,
Right.
but we do forward commitments on properties that have tax credits, meaning we will commit to take out the construction loan when construction is complete and the property is stabilized. In
Mhm.
those scenarios where you have rent or income restrictions in place, or nonprofits we can consider under our non-LIHTC forward program. So it's essentially forward commitments for non-tax credit properties. So I think we probably could look at it in that scenario.
Mhm. You know, in that scenario, a strong CDFI could be that construction lender that you could take out. So let me stay on the CDFI vein just a minute. A very important part of serving underserved markets, right, can be extremely important. Like take Rock USA Capital and the financing that they do as one example. And you know, Next Step has a member in Maine, right, that's doing chattel lending is another example, and we see that in Montana too. So I know there's limitations from FHFA and maybe some interpretations on investments. As advocates, and Jim, what could we do to try to push the regulator and Fannie and Freddie to make equity investments into CDFIs to get more work done in this space? Is it even possible?
Well, so maybe you intended that for me, Stacy, at least first. So,
Yeah.
you know, I've been hard on my buddies Dennis and Corey in this call and really pushed them on a lot of things. But something I alluded to earlier in the call that I should make more of a point is that they are, to some extent, fighting with one hand tied behind their back because of all the changes that former director Calabria made at FHFA that make it harder and discouraged affordable. And when Lincoln Institute put together our comment letter on the plans, you know, we didn't even talk very much about the plans. What we focused on were the things that we want to see changed at FHFA. And really going back to the very first part of this conversation, if President Biden wants it to happen, it could happen later this week. And so it's really a matter of, I think the most urgent thing is FHFA making the changes that need to be made so that Corey and Dennis and their colleagues and competitors at Fannie Mae are in a stronger position to make the changes that we want to see them make. And we laid out in that letter 3 specific changes. One of them was the one that you mentioned, which is making these equity investments that would be so important in the manufactured housing space. Another one actually happened last week, which is the capital regulation that FHFA has is just, it's over the top, ridiculous. It makes the capital requirements for the kinds of loans that we want to see, including manufactured housing loans, just out the roof. And so it looks like FHFA is on the road to making that change. The third change is former Director Calabria pretty well shut down most pilots. And there's this rulemaking out there they call it the new products rule. It should maybe be called the no new products rule, because it does so much to shut down pilots and new products. And so that's the third thing that we sure hope Acting Director Thompson will really put emphasis on, to change that and to encourage the enterprises to engage in pilots. Maybe that's more than you wanted, but I wanted.
Perfect, I think, in terms of what I wanted. So, and I want the advocates to hear this, that really, if we want Fannie and Freddie shaped, we've got to shape FHFA. And, you know, you do that by participating, right? That's one of the ways that you do that. I think we'd all love to see where Fannie and Freddie could place equity investments in CDFIs. I was encouraged to see some of the innovations made in finance with CDFIs over the Duty to Serve program, particularly in rural settings where, you know, Fahey and Appalachia and folks in Texas were able to become seller servicer, I think one at Fannie and one at Freddie. So there's some innovation, right? We could do more of this work. And so I think we're on the right track here. Let me just take us to talk about the COVID issue. Oh gosh, aren't we all tired of COVID? But here we go. I just want to share a little bit of data. You know, a next step, we were really kind of wondering and concerned about how manufactured homeowners were faring under the COVID economy. So we reached out to our friends at the Urban Institute in 2020, and they took on a study. And what they found is that, you know, within manufactured housing, 71% are owners, and 35% of those owners worked in 5 industries that lost the most jobs during the crisis, okay? You compared that with only 24% of owners of single family homes, okay? 43% of renters of manufactured housing also worked in these 5 most vulnerable industries, okay? So basically what the report said, that owners of manufactured homes are slightly more vulnerable than renters of other types of housing. I mean, the families that we care about, the individuals and families, were the most vulnerable to the shocks of a COVID economy and job loss, okay? That's what the report told us. So the FHFA and the enterprises have made meaningful efforts to respond to COVID. They've done a great job. They've been really focused on that. I kind of think they came off some of the duty serve stuff. They had to start focusing on COVID. But most manufactured homeowners, they didn't fall under any government protection at all, you know, because they missed out on counseling and foreclosure prevention and all this mitigation. They did not receive information on how they could access a HUD housing counselor, which really serves the front lines anytime we have a crisis of helping homeowners navigate delinquency and mitigating foreclosure. So I'm going to be asking several of you, what lessons should the manufactured housing sector take from this response to the crisis as we prepare for the next one? What steps should Fannie and Freddie take to make sure homeowners receive counseling and foreclosure mitigation that it's offered to all manufactured homeowners? And the reason we have this problem is because we don't have enough government-backed loans or Fannie and Freddie products penetrated in the market. The portfolio lenders still dominate this space, right? So this is why, and so therefore they don't fall under these government protections. So David, would you like to comment on that?
I think just this topic alone is worth probably a 90-minute call. I read the same study, you know, and it's just factual. I was going to say it's unfortunate, but it's just factual that so many were impacted by COVID in those 5 industries. You know, and I think I'm looking forward, you know, and Jim was talking about, you know, variances in terms of business with Freddie Mac, Fannie, now under Acting Director Thompson. Things are so much more open to do so and to have those conversations. and to actually open the homeownership door to a new population of aspiring homeowners. So, and they could be outside of those 5 sectors that you were talking about that were really kind of decimated by COVID. So, you know, I think that, you know, I go back to saying, okay, right now, manufactured home loan or manufactured homes are about 10% of our housing right now. And I do think that, you know, that should be more like 15 or even 20%. There's no reason why it shouldn't be, but it needs to be outside of those 5 employment sectors that you're speaking of. Again, it's unfortunate what happened to so many in so many different ways. I'm just all about, you know, what can we do kind of going forward. And I go back to just the creativity that lenders now are open to strategically talk about with the GSEs, and just to try to open up that homeownership door to just a new population of folks.
Yeah, you know, one of the ways would be if we did had chattel lending, right? But I think that if we do chattel lending at the GSEs, we really need to tie the homeownership counseling and all these services, right, and these protections for the home buyer. So, and Dennis, do you want to add to this conversation?
So I think you kind of pointed out the difference between the chattel and the mortgage currently, right? Because we require our servicers who service loans they sell to us, whether it's a manufactured home loan or a traditional site-built home, to go through certain workout waterfalls and cascades to make certain that those customers are receiving the options as well as access to post-purchase counseling when they need it the most. We did shift our resources to allow for those waterfalls and really focus on the forbearance, working with our regulator, FHFA, and with Fannie Mae to bring things to the market in a timely fashion that could help a litany of customers. And one thing that we're doing next year is we're going to look at those MH home buyers who took advantage of the forbearance to try to identify any trends. That way, proactively, we could help customers in the future. Maybe that's through our borrower help centers and other servicers who provide that home buyer counseling and education.
Mm-hmm.
And to work with our servicers too to potentially identify some of the key factors that may be triggered and were a result of that customer requesting the forbearance. But I think having those protections beyond just the GSE and the government-sponsored loans would be very beneficial for the homeowners.
And I think Fannie and Freddie have done a really good job with the loans that you had, and people were protected, but we were talking to people outside of your reach, right? And so what are those lessons learned? So I'm sitting here thinking about if we do chattel lending in the future, one thing that I think everybody needs to remember that today's counselors don't understand chattel lending unless they've spent a lot of time with Next Step. They don't know how a loan unwinds on the back end, right? So you're going to need to, I think as an industry, we're going to have to invest in the homeownership counseling field really to do this work for future forbearance mitigation work that we'll need to do. So Jim, anything you want to add to this?
No, I think you've covered it very nicely. I agree with everything I'm hearing from you and Dennis. But
Okay.
you know, since you asked me a question, there is one other thing that we haven't touched on, or actually you did touch on it. I think you've done a really good job of trying to make this panel accessible to people and to focus on what they can do on the advocacy side. One thing when you asked that question earlier that didn't occur to me that has occurred to me since is our FHFA now has an RFI out, or a request for public input that's outstanding, that's not due until October 25th. And the subject of this RFI is racial equity. But you know, manufactured housing is a great way to address racial equity. And it doesn't look like Prosperity Now has allowed me to send something to everybody in the chat, but I'm putting it in here to the organizers and the panelists, and with a request that Prosperity Now, please send it out to everybody so that everybody who's in this session can see this FHFA request for input. And I would encourage all of the people on this in this session to reach out to FHFA before October 25th and talk about the importance of manufactured housing, to racial equity, and you could mention these three things that that we talked about earlier that FHFA needs to do. I'll list them one more time. One is the capital requirements that they've started to change. A second one is permitting targeted equity investments, and the third one is encouraging pilot programs.
Mm-hmm. Yep. Thank you, Jim. And let's stay on racial equity a moment. I think it's really important that the audience knows that there's new research out, and the Consumer Financial Protection Bureau has put out a report this year. You know, MH loan denials based on the HMDA data are much higher than those for site built. Black, Hispanic, Indigenous homebuyers are more likely to be denied than whites. Okay, even when denials by credit history are omitted. So we've got some work to do here, right? And so why is that? And how can maybe some of these programs and products help address this? Dennis, you want to speak to that?
Sure. So this is something that Freddie Mac is committed to, and we're actually standing up a group to work on this equity in housing. So, you know, there's several ways we could approach this. One is obviously through a homebuyer education. That way the homeowner can understand budgeting, they can understand credit, they can understand all of those components that go into qualifying for a loan or a mortgage loan. I think it's really interesting because it's just the last couple of years that HMDA data has included all of the manufactured home data in it. So it's going to be interesting to be able to see how we can cut and slice some of that data. But I think one of the challenges too is in the chattel space. I think that's where, based on some of the numbers that I've seen, we can have the most impact for equitable lending and equitable home ownership. But I think that's something that we need to look at. And as we discussed earlier, look at, is this something that we can continue to develop with a new lens?
Okay, thank you, Dennis. Jim, anything you want to add there?
No, I think
We got it?
we covered it. Yeah.
Okay, and David, you're okay with that too?
I am. Yeah. The only thing I would add is, you know, just had understanding the numbers, you know, that you and Dennis were referring to, but then also understanding, you know, what to do with it. You know, like Dennis had said before, you know, Guild and Freddie Mac, we're going to various markets around the country between now and the end of the year, doing very targeted virtual sessions on educating with manufactured homes, where they come from, what the financing options are now. And again, those markets are kind of chosen for a reason. So going back to some of the numbers that you're referring to and from Urban Institute, so it's really to kind of help bridge that homeownership gap with some of those groups that you're referring to.
Okay, all right, thank you. Yes, racial equity. I know it's on more and more people's radar. How do we address this? So I'm glad to hear the work being done on this. I think we're getting ready to kind of wrap this up and move to the Q&A section. But before we do, I always have to make a plea here. You know, I come from Appalachia. I want to just speak a moment to the millions of families that are living in homes built before 1976, our mobile homes. They're the most energy inefficient homes on the grid. Many of them need replacement, and our, you know, our most restrained income families and individuals live in these homes. A lot of work to do here. So I would just encourage from a mission point that we think about these programs in the persistent poverty regions where it's most prevalent, and highlight that the Federal Home Loan Bank of Cincinnati is looking to innovate a pilot program in the region to begin to address this. So I know they would love to have partners at the table with them as they work on that. So let me thank all our panelists today for participating, and I am going to turn this over to Dara to post some questions for us.
Yes, thank you, Stacy. So we had a lot of questions coming in during this webinar throughout it, and you responded a lot sort of related to the same thing, and you all kind of responded to, you know, protection, tenant protections, that kind of stuff. But relatedly, there were a few questions around who is being invested in under duty to serve. So, and questions and concerns really about investing in home buyers rather than, you know, other investors in these communities. So can you all speak to that and what you're seeing and what can happen there?
Dennis, you want to take the first step on where investments go from Freddie Mac's point of view?
Absolutely. So I think from duty to serve, we have several investments on the single family side where we come alongside some of the nonprofits and leading housing advocacy groups to help expand their reach. For example, we worked with Next Step, Stacy's organization, to finalize the manufactured home buyer education curriculum and stand that up, and have been very successful with working with retailers and lenders and the nonprofits to educate customers about manufactured homes. So some of the investments that we do is expanding the technical assistance and the capabilities of those nonprofit groups. In our rural areas, we've invested with some of the tribal areas and tribal entities to bring education to the tribal community members to help increase their home ownership rate. So those are some of the things that we invest in, as well as our products and programs to help provide liquidity to our lenders so that they can go out and support more home buyers and homeowners through their mortgage transaction.
Yeah, thank you, Dennis. And I'll add on to that. You know, Next Step works with both Freddie Mac and Fannie Mae. And like some examples of some of these investments, you know, monies have passed through Next Step, through these organizations to Next Step. We in turn have passed them to our nonprofit partners in the field to build new affordable manufactured homes in both Virginia and California. And then those are made available to the home buyers and they're supported. Some of these homes we've innovated with solar out in California, for example. So these are the types of programs and investments that we've been making. We're working with Fannie Mae right now to do a new development in Hagerstown, Maryland, for example. They're investing in our counseling network to really discover how to better prepare counselors to support home buyers. But we're happy to take another question.
Yes, another question is whether duty to serve will help get more lenders to participate in first-time home buyer options. This person comes from California who asked this question, who doesn't see many options in the manufactured home space for first-time home buyers there.
David, why don't you talk a little bit what Guild Mortgage does maybe in the California market?
Yeah, sure, love to. So Guild is, so I'm bragging a little bit. So I know that we're both Fannie and Freddie, the #1 manufactured home lender in the country. So very proud of that. Guild is also one of the top lenders for housing programs throughout the country. So in pretty much in every state we're in, we work with that state's housing programs, which many of them do include manufactured homes. Whoever asked the question, I'm a Californian as well. So trust me, we do quite a bit of manufactured homes in California. And then the prior question was about investments. these housing programs that I'm referring to, that's about 10% of our business. And trust me, it's not 10% of our profit. So these are, it's quite an investment just to do them in the first place. In California, as an example, up in Northern California, there's a fire that kind of decimated a community called Paradise. 95% of the town was burned. And our company actually is investing back into the town to kind of help rebuild Paradise. And we're doing that in actually purchasing multiple lots and actually putting in some cross-mod homes. So whoever asked the question, feel free to reach out to me directly. More than happy to talk to you about that.
Okay, so we are at time for this webinar. I know there are dozens more questions that came in, so this was a hot topic today. So thank you to our speakers for joining us, especially to Stacy for help guiding us through this conversation. And on this slide, you'll see the contact information for our speakers. So again, there's David's information there to reach out to about that California issue. And if you have any questions for these speakers, feel free to reach out. Mm-hmm. And we hope to see you all at tomorrow's session. So thank you.
Thank you, everyone. Good job.
Thank you.
Thank you all.
Thanks for having us.
Yes.
Thanks, panelists.
Bye.
Nice to meet you, David.
Great job, Stacy.
Oh, thank you. We pulled it off. Good. Thank you all.